I'm excited to welcome Meb Faber to our Chicago Raymond James Private Client Office. We're in for a really good conversation. I know you're based out of California and made the flight over to do some traveling and visiting some offices here. But I wanted to spend some time to just really pick your brain on a lot of different ideas, get to know some of your background, and just have a conversation on just what's on your mind and talking about, what should the average investor look for when it comes to global allocation, dividends, value investing, all these things that we hear about. So
Right.
with that, Meb, brief introduction about yourself, and then we'll get rocking and rolling.
Yeah, we're my day job is an asset manager. We have an ETF company located in Manhattan Beach, California. If you're ever in town, come say hi. We'll take you out surfing.
Sounds great.
Our oldest fund is over 11 years old now. We have 15 funds, about $2.5 billion under management, and over 150,000 investors all over the world, and funds focused on all sorts of different things, but we tend to focus on rules-based, quantitative strategies, both macro and micro and everywhere in between.
Yeah, so I noticed you have a really impressive background, right? And from being an author, your podcast, from writing your papers, what was your initial interest into this business, into finance?
Like many, we don't teach finance and investing in schools, for the most part, elementary, middle, high school, right? We don't really teach money, which is a shame. I think we should. It's only about, I think, a quarter of all high schools now. That number's coming up. So, many get interest from elsewhere. I was an engineering student, biomedical engineering, but that was really during the great bubble for U.S. stocks in the late 90s. I graduated college in 2000. So it wasn't just an internet bubble, it was also a biotech stock bubble. So I had one foot on each side, the biotech side as well as the investing bubble side. And so I was paying a lot of attention. I mean, I had professors trading stocks during class, engineering professors, right? And so, it definitely colored my experience like every investor, right? If you grew up during different regimes, some people have far different experiences, not just in the U.S., but other countries all around the world. And so I graduated in that period, was planning on going back and getting full PhD in biomedical engineering, but I said these markets are just too interesting, seduced by that world, and here we are 20 years later, and my hobby is the career and vice versa.
Yeah, so isn't it fascinating, where you can build portfolios, you can, go online, do the research, and I know you've done a lot in the value space, and you talk a lot about diversifying across global allocation funds. So can you talk a little bit more about that?
Sure. We actually just wrote a recent piece called The Bear Market and Diversification. And we have an old book called Global Asset Allocation. It's free to download, where we examined a lot of the great famous asset allocation models that people have suggested throughout history. Classic 60-40 portfolio, the global market portfolio, if you just bought every public asset, risk parity, endowment, on, permanent portfolio. And they all did a good job, right? And over time, now they zigged and zagged. Things in the 70s that had gold and commodities did better. Things in the 80s and 90s that had stocks did much better. But they all kind of went up over time and did a good job. However, this period post-global financial crisis has been not a totally unique one, but one that doesn't come around that much, which is, and this is technical terms, U.S. stocks have just ripped the face off everything else, right? They've done 15% a year since the bottom in March 2009. And so really, I mean, first of all, that's fantastic. If you own U.S. stocks, God bless you. If you own anything else, that's hurt your return. Now, it hasn't been bad, so most of these portfolios have done about 7% a year, which is great. But the worst thing in investing, Charlie Munger and Buffett used to talk about this. They said markets aren't driven by greed and fear, they're driven by envy. So if you have a beautifully globally diversified portfolio, but your neighbor's doing 15% a year, that's the worst. And so for financial advisors, for example, sit down with clients every quarter. Clients say, why do we own emerging markets? Can you tell me, why do we own bonds again? What's this? REITs, commodities, foreign stocks, value, everything. And this has been one of the biggest periods in terms of relative underperformance versus the S&P. But the worst part is it's not just the magnitude, it's the years in a row. So it was something like 13 of 15 years the S&P has beat most traditional asset allocation portfolios, and that's hard. underperforming your neighbor and not looking as good as what's going up.
Yeah, it's funny you mentioned that. I could think about like conversations with your golf buddies on the golf course, and he's like, "Hey, I'm up this amount," and maybe you're not as much, but it also tells into diversification and your risk tolerance. Some may not have that risk tolerance. So how important is that? Really getting an understanding of what risk you're willing to take and what type of a ride, and what does volatility mean during that process?
Look, we always tell people the key is to look back in history to at least get a baseline with the humor and knowledge that it's always going to be different. So if you look back and say, hey, is this unique? Has the S&P done this before? And you say, yeah, it has done it. Now, the 3 other times all have names where the S&P on a 10-year rolling basis has done 15% a year. It happened in the roaring 20s, so 100 years ago.
Yeah.
It happened in the nifty 50s, and then it happened in the internet bubble, my favorite, right?
Yeah.
Where this period where everything was just compounding, stocks were doing great, and usually by the end of it, people were extrapolating that into the forever future.
Yeah.
And so this really culminated, I think, this cycle in 2021, February, where the whole meme stock mania, there's a lot of just craziness, everyone trading zero-day options. And so you still have some echoes of that today. I mean, look, NVIDIA, my goodness, $3 trillion corporation now, good for them, astonishing story. But the assumption that these things last forever gets investors into trouble because every asset class has its day in the sun and day in the shade. It doesn't matter if it's gold, it doesn't matter if it's real estate, U.S. stocks, foreign stocks, and it doesn't last forever.
Yeah, that's great that you share that. So I want to transition a little bit to value investing. What is it for the average investor? And for someone that has a 15, 20, 30-year horizon, can you talk to that a little bit?
When you think about most other areas of personal finance or your everyday life, there's really no area where price is not an input. And so if you think of traditional indexing, market cap weighting, God bless the late Jack Bogle, 50 years ago really pushed this out to investors with Vanguard. Huge innovation, but it wasn't as much that it was market cap weighting, it's what that allowed, which was low cost investing. And so now in 2024, we have a situation where you have active ETFs, you have funds that can be tax efficient with turnover, and so it doesn't have to be market cap weighted. And so then you say, okay, well, my menu is much more varied and I can invest in any type of style. And so value investing, look, it's got its roots at least 100 years, time of Ben Graham and others. But the concept of an investment, a stock, a business having a price, right? Having an intrinsic value, everyone gets that. Except when you start to talk about stocks, sometimes it goes out the window. And so, trying to buy an investment that has cash flows, that'll be able to pay you over time is really the foundation of all of business, right? And so most people forget that a traditional index doesn't have that input, which is its Achilles heel. It's just the price of the stock times shares outstanding for the market cap index. So having that tether to value is hugely important. Most of the time it doesn't matter, but when things go totally nutty, late 90s, 2021, having that tether to value can really protect your hide when you have the bear markets and the downsides, which are a normal part of markets, and in some cases can get pretty deep.
Yeah. So what rules do you use to just remain consistent along the way, right? The average investor, sometimes ups and downs can really throw you off your game plan. But someone in your space, what are the quantitative data points? What research? What are you looking at when you're talking about the next 15, 20, 30 years?
Key word you used is rules. Most investors, they don't have a plan, and so often we hear, I'm going to buy this investment and we'll see how it goes. Like, what does that even mean? And so studying history is like the great first step, and then second is like, can you actually craft a plan? And this is where financial advisors come in, is they actually say, hey, we're going to build this plan, because we all know that just buying a bunch of investments, winging it, when it hits the fan or when things get scary, your investments go down a lot, the emotions creep in, and that's where the fractures happen, because people look around, 2008, 2009, I don't know how many times I heard people say, I couldn't take any more, I sold it all, never bought back in.
Some in 2020.
Yeah, Yeah, same thing. And so having the plan at least it gives you a rudder, right? It gives you some base to work from. Now, it doesn't mean you can't ever alter it, doesn't mean you can't update it, improve it, but it gives you kind of the foundation. It doesn't have to be complicated. We tell people it could fit on an index card, you know? But at least having that is a good starting point. And then you can kind of move to other steps on how do you approach investments. We did a recent podcast with Professor Ken French, for example, and we were talking about active management. And I was saying, you know, how long do you need to know that an investor is good, right? Because so many people, their time horizon is 0 to 3 years, right? I mean, and nowadays it's like 0 to 3 months.
Yeah,
forget
0 to
it.
next Friday, right?
And he said, Meb, you're not going to believe this, but statistically speaking, it's 64 years. And I said, well, that's a little longer than I would expect, but he's like, there's so much randomness and noise in short-term performance, not just for active managers, but also for asset classes. You have things like, you know, whether it's stock or real estate or gold can go a decade and not have any returns. And so I think it's hard for people to really condense that time horizon where they think it has to happen
60
now.
Plus years. And
Yeah.
Impressive.
Yeah.
Yeah. So right now we're hearing a lot about AI. This is, you know, we hear that's a revolution. This is something we've never seen before. This is going to change the game. What are your thoughts?
You know, it sounds great. I agree. You know, but it's funny when you talk about investments. You look back in history. There's a lot of great books that chronicle a lot of the innovations of the past, right? And when we look back in the 1920s, I mean, I think there was a bubble in utility and railroad stocks. Like, how you get excited about that?
Right.
But that was the technology, that was the AI of the day. And so you always have to make the distinction between the business and the stock, right? So 99, when I graduate, there was incredible businesses. Cisco Systems, still one of the top companies today. A bunch of these stocks got to just crazy valuations. The business did amazing for the next 20 years, but the stock did nothing, right? And so you always have to have, you know, kind of at least a little bit of common sense about, you know, this distinguishing between the two. And because you can have a lot of businesses that are, you know, only average, but maybe their stock is super cheap, you know. And so there's always technological revolutions going on. We keep an eye on AI. I haven't really created a Meb 2.0 yet, Meb 3000 to do the podcast and research, but we're working on it.
Yeah. So last question for you. You know, the audience consists of typically advisors, some that are starting now or some that have been in the business for 30 years. So what advice would you give to an advisor who's meeting with clients, who is, you know, helping them plan, sticking to a plan for hopefully the next 60 plus years, someone starting today versus someone that's been in the business for 30 years?
Well, the guy or gal who's been in the business for 30 years has experiences that are hard to convey. So a good example would be, you know, most people who have been investing, young people, 15 years now, they've seen one environment, and that's stocks go up, right? If they happen to go down 20%, they go right back up. But you talk to an advisor who's been around for a lot longer, they know that's not always the case. You have environments that have existed in the US, but elsewhere. So a good example is Japan. You know, Japan in the 1980s was the largest stock market in the world, and it got to be the biggest stock market bubble we've ever seen. But then Japan had no stock market returns for 30 years.
Wow.
So an entire generation of Japanese people, try to say buy and hold, they say, what are you talking about, right? And so advisors who live through that, they have that experience, and they can kind of say, look, you know, we've been through this before, been through that, and because the markets are crazy, let's be honest. And in the younger crowd, look, it's also, I think, to have a little humility and kindness to yourself. I think the older investors and traders realize you're going to have a lot of losing investments. You're going to have a lot of scars. And one of my favorite quotes about investing is, every trade makes you richer or wiser, but never both. Meaning you don't really learn much from the winners. You like to brag and tell people how smart you are and how much money you made, but really it's a lot of the losers that give you that education. And we're all going to go through that. And even with asset allocation, the famous phrase is like, diversification means you're always having to say you're sorry because something is doing bad, but that's the whole point, right? Is that the things zig and zag in the portfolio so that it's a smoother ride. And so it's not always going to be U.S. stocks. Sometimes it's going to be something else. But having the humility to realize you're not always going to be right in this game is, I think, a big key.
Yeah, well, I want to thank you for joining. Very impressive background, author of 5 books, podcast with over 500 episodes, your Meb papers, and also joining us here in Chicago. So thank you so much for your time.
Thanks for hosting.
And excited to have you.